Today, we are diving into the variations of term life insurance for the national portion of the insurance exam. Understanding these variations is crucial because the exam will test your ability to match a specific insurance product to a specific consumer need. Let us start with level term insurance, which is the most common form you will see on the test. In a level term policy, the word level refers specifically to the death benefit or the face amount of the policy. If you buy a $500,000 level term policy, that death benefit remains $500,000 for the entire duration of the term, whether that term is 10, 20, or 30 years. The premiums also stay level during this period. A common exam trap is a question that asks what happens to the premium in a level term policy as the insured gets older. The answer is that the premium remains the same throughout the duration of the term. However, if the policy is renewed at the end of the term, the premium will jump to a higher level based on the insured's attained age. This is called the step rate premium. You must remember that level term provides the highest amount of coverage for the lowest initial premium, which is a key concept tested on the exam. If a question asks which policy offers the most pure protection for a set period, level term is your answer. Moving on to decreasing term insurance. This is a variation where the face amount or death benefit gradually declines over the life of the policy. Even though the death benefit is dropping, the premium remains level throughout the entire contract. This is a major point of confusion on the exam because students often assume that if the benefit goes down, the price should go down too, but that is not how it works. On the exam, you will almost always see decreasing term linked to a mortgage or a large debt. The logic is that as you pay off your mortgage, the amount of insurance you need to cover that debt decreases. If you see a question about a client who wants to ensure their family can pay off a 30-year mortgage if they pass away, then decreasing term is your go-to answer. Just watch out for trick wording stating that the premium decreases because that is factually incorrect. The death benefit is what reaches zero at the end of the policy term. Then we have increasing term insurance. In this variation, the death benefit starts at a lower amount and increases over time. This is rarely sold as a standalone policy and is almost always found as a rider attached to another policy. You will see this most often in the form of a return of premium rider or a cost of living rider. For the exam, remember that the increasing term amount is usually tied to a specific dollar amount or a percentage of the original face value. If a question asks which policy would best help a client keep up with inflation, then increasing term is the characteristic you are looking for. To keep these straight in your head, use the mnemonic level stays flat, decreasing kills the debt, and increasing adds the extras. This reminds you that level keeps the benefit the same. Decreasing is for amortizing loans like mortgages, and increasing helps fight the rising cost of living. Another trap to avoid is the distinction between annual renewable term and level term. Annual renewable term has a death benefit that stays level, but the premium increases every single year. Contrast this with level premium term, where both the benefit and the price stay the same for the duration of the set period. When you see the phrase level term on the exam, always ask yourself if they are referring to the death benefit or the premium, because the exam will try to switch those concepts to see if you are paying attention. Mastering these distinctions ensures you will not get tripped up by the subtle phrasing used by exam proctors. Use your knowledge of these variations to match the policy to the specific financial need described in the test question, and you will find these points easy to earn.